Here's what you need to know before we start. The guy who stole from you, he wasn't some random hire. He wasn't someone you'd had doubts about. He was the employee you trusted most. The one you'd given keys to. The one who handled the finances because you decided 4 years ago that he was the most reliable person on your team. And it's a Thursday afternoon. Quarter-end expense review. You're going through the books the way you do every 3 months. Routine, kind of boring, the administrative stuff you've never particularly loved but always done because that's how you keep the machine running clean. And you hit a line item that doesn't add up. $7. A $7 discrepancy between what an invoice says and what it should say based on the vendor's pricing sheet. $7 on a line item in the mid-300s. You almost scroll past it. I want you to really sit with that for a second. You almost scrolled past $7. You didn't. And that $7, that one rounding error on one invoice, is the thread that unravels $190,000 worth of theft across 36 months. $190,000 from your own company, by the man you trusted most, for 3 years, through a ghost vendor he'd set up specifically to steal from you. And you found all of it because of $7. We're going back to the beginning. But I'm going to need you to stay with me for this one. Because it gets complicated and it gets personal and it gets, honestly, a little hard to look at. But it ends where it needs to end. That I can promise you. So you own a commercial HVAC maintenance company. Glamorous, not the kind of business anyone starts because they're passionate about it. You started it because you'd worked in the trade for 6 years, watched the company you were at get bought out and gutted, and decided that you were done building other people's equity. That was 9 years ago. You incorporated on a Wednesday morning in March, just you and a used service van and 3 clients you'd brought over from your old employer. 9 years later, 18 full-time employees, 4 vans, 1 small office space above a flooring shop, and somewhere around $4 million in annual revenue. Not impressive to a Silicon Valley guy, but genuinely solid for a trade services business built without outside capital. You did it the slow way, 1 contract at a time, word of mouth, never taking on more than you could actually deliver. That discipline is the thing you're proud of. That and the fact that you still do the Thursday books yourself, which your accountant thinks is slightly paranoid for a company your size. Turns out it wasn't paranoid enough. Ryan Ortega joined in year 5. He came as an office manager, scheduling, vendor management, accounts payable, the administrative infrastructure that keeps a service business from collapsing under its own paperwork. You'd interviewed 4 people. Ryan was the most capable by a clear margin. Systems thinker. Asked good questions about the business. Had a background in small business administration from a previous role. You offered him the job on the spot. Over the next 4 years, Ryan earned the trust incrementally. He digitized your invoice filing system. He rebuilt the vendor tracking spreadsheet that's been the same format for 9 years, and that, in retrospect, had exactly 1 vulnerability he'd later exploit. He managed relationships with your suppliers, parts vendors, equipment leasing companies, the handful of specialist contractors you brought in for specific jobs. He handled accounts payable almost entirely on his own, which you'd allowed to happen gradually as confidence in him grew. That's standard for a company your size. You're not equipped to have a full finance function. You trusted your best administrator. Ryan was good at being trusted. That's the thing that takes longest to process after all of this. He wasn't slick. He wasn't overeager. He was just reliably, consistently good at his job. The kind of employee you brag about slightly when someone asks how the business is running. I've got a great ops guy. You said that to people. You meant it completely. He started the ghost vendor scheme in year 2 of his employment. 2 years in, but not immediately. He waited until he had full access, full familiarity with the systems, full understanding of where the blind spots were. He waited until he knew exactly what he was doing. That's the part that stays with you. Right, so, ghost vendor. Let me explain what this actually is, because the details matter, and because if you run any kind of business that pays external vendors, what I'm about to describe is something you should actually understand. Ghost vendor is a fake company. It's a business entity registered with an EIN, maybe even a basic website that exists only to receive payments. It doesn't provide services. It doesn't supply anything. It's just a name on an invoice and a bank account that collects the check. The person running the scheme creates the company, adds it to the vendor list, and submits invoices for it at whatever cadence seems safe. The invoices look like every other vendor invoice. The amounts are usually modest enough to stay below scrutiny thresholds. And if the person managing accounts payable is also the person controlling the vendor list, the same person, the same guy with access to both sides of the transaction, there's almost no natural checkpointing that catches it. Ryan's ghost vendor was called Pacific Coast Equipment Solutions. He registered it in Nevada, not your state, which added a layer of distance that made it slightly harder to cross-reference against your local vendor base. He gave it a basic website, phone number that rang to a Google Voice account he controlled, professional-looking invoice template. If you'd ever called the number or looked up the address, you'd have found nothing useful. A virtual mailbox, a generic website with stock photos of industrial equipment, something that would immediately say, "This is fake." He submitted invoices from PCEAs, that's the abbreviation he used in your system, at a rate of roughly 1 to 2 per month. Amounts range from $800 to $4,200, always within the range of what a legitimate parts or equipment vendor might invoice you for. Never so large that they get flagged as an anomaly. He spread them across different project codes so no single project showed an unusual vendor concentration. He was genuinely careful about it. The design of the scheme shows someone who thought through the failure points in advance. What he didn't account for, and this is the $7 part, was that he occasionally changed the PCES invoice template, updated the logo, tweaked the pricing format, whatever. And in October of last year, on one specific invoice, the price per unit on a filter assembly line item didn't match the pricing sheet he'd uploaded to your vendor system 2 years earlier when he'd originally onboarded PCES. The math still worked out. The total on the invoice was correct. But the unit price was $7 different from what the archive pricing sheet said it should be, which meant the quantity implied didn't match the units actually ordered. $7. One cell. And you happen to be the kind of business owner who still does his own quarterly books on Thursday afternoons. So here's where your brain does that thing. The thing where it presents you with 2 explanations and you desperately want the innocent one to be right. Could be a template error. Could be a price update he forgot to file in the system. Could be absolutely nothing. You've known this guy for 4 years. He's never given you a single reason to doubt him. But you don't bring it to him. That's the decision you make in the 30 seconds after you notice the $7. Not consciously, not with a plan. You just don't mention it that afternoon. You close the spreadsheet. You finish the review. You go home. And that night, you pull up the vendor system on your personal laptop, your own login, not the shared admin account Ryan uses, and you start looking at PCES. Pacific Coast Equipment Solutions, in your system since month 7 of Ryan's employment. 14 invoices across the past 2 years. Total, $42,300. You stare at that number for a while. $42,300 to a vendor you've never once personally dealt with, spoken to, or verified. Which, now that you're staring at it directly, is something you should have noticed before and didn't because you trusted the man who managed vendors to manage vendors. You Google Pacific Coast Equipment Solutions. The website exists. It looks fine. Generic. Stock photos. Serving commercial and industrial clients across the Pacific region. No client list. No physical address listed. Contact form. You fill it out at 11:23 p.m. and hit submit. You're not expecting anything. You're testing. You call the number on the website the next morning from your personal cell. It rings 4 times and goes to a generic voicemail. You've reached Pacific Coast Equipment Solutions. Leave a message. No name. No return call. Nothing. You do not confront Ryan. You do not ask him about PCES. You go to the office Monday, have a normal week, talk to him about scheduling and a client contract renewal, laugh at something he says at the Wednesday all hands. Completely normal. And the whole time you're running a search in the background, quiet, systematic, because you're a business owner who builds systems and you're going to build this one right before you blow anything up. By the end of week 1, you've pulled every PCES invoice going back to when the vendor was first onboarded. You've cross-referenced them against the actual job codes they were billed to. You've checked whether any of the parts or equipment described on those invoices correspond to orders in your project management system. They don't. One item on any PCES invoice maps to an actual purchase order you can trace. There's no equipment. There are no filter assemblies. There's just $42,300 paid to a company that, when you check the Nevada Business Registry on day 4 of your quiet audit, turns out to have been registered 12 days before it first appeared in your vendor system. Registered 12 days before, by a registered agent whose generic LLC services are available to anyone willing to pay $49, with a mailing address that is, in fact, a UPS store in Las Vegas. You're not calling this an innocent template error anymore. You're calling your accountant on a Saturday morning. Your accountant, her name is Sandra Lim, she's been handling your books for 6 years, and she is the kind of CPA who hears, "I think I found a ghost vendor," and doesn't say, "Are you sure?" She says, "I know someone, give me an hour." The someone she knows is a forensic accountant named Malcolm Reed. Malcolm has the energy of a man who enjoys finding money that's been hidden. Not in a dark way, in the way a good detective enjoys the investigation. He's thorough to the point of being slightly obsessive, which is exactly what you need when someone has been carefully hiding something for 2 years. You bring Malcolm in under the premise of a routine financial audit, which you tell Ryan is something your bank is requiring as part of a credit line review. That's the cover. It's believable. Ryan accepts it without visible concern, which you think afterward is either because he believed it or because he believed his work was clean enough to survive scrutiny. Neither reading is great. Malcolm works for 6 weeks. Limited access, he's auditing from your side of the books, not tipping off Ryan, not pulling anything from the shared system that Ryan would notice has been accessed. He's specifically auditing the accounts payable trail. Every vendor, every payment, every project code, going back 3 years. Here's what he finds month by month. Year 1 of the scheme, Ryan's year 3 of employment, 13 PCES invoices totaling $38,400. Ounce ranging from $800 to $3. Frequency, roughly 1 per month, sometimes 2. All within the range that a normal vendor might invoice for parts and equipment. Year 2, 21 invoices totaling $71. The average invoice amount has grown. He got bolder, or maybe more comfortable, or maybe just more in need of the money. You don't know yet which it is. Year 3, 17 invoices before your quarterly review, totaling $8,400. He was on track to exceed year 2 before the $7 caught him. The amounts had grown again. Some individual invoices were now in the $4,000, $5,000 range. The ceiling was rising. Total, $190,000 over 36 months, paid to a company that has never existed, never provided a service, never shipped a part. Company that Ryan Ortega registered 12 days before he onboarded it as your vendor that he controlled and that deposited your money directly into a personal account in his name. Malcolm presents this to you in a conference room at Sandra's office on a Wednesday morning. There's a binder. It's 42 pages. The executive summary at the front is 1 page. The last line of the executive summary says, "The evidence supports a finding of intentional, systematic employee fraud via ghost vendor scheme." You read that line twice. You put the binder down. You ask Sandra to give you 5 minutes. You go to the bathroom, run cold water over your wrists. Weird instinct, but your body needs something, and you stand there for a while. Because you're surprised, exactly. You've suspected for 6 weeks. You've known for 2. But knowing and having 42 pages of documented proof are different things. The binder makes it real in a different way. The binder makes it something that happened. Here's the thing about Ryan, and I want to spend some time here because I think this part matters more than people expect. He wasn't some predatory hire. He wasn't someone who came in planning to steal. Or at least, you don't think so. You can't know for sure. But the picture that emerges over the weeks of investigation doesn't look like someone who walked through your door with a plan. It looks like someone who found an opening and took it and then couldn't stop. What you find out later, through the legal process, is that Ryan had been in financial trouble from almost the beginning of his time at your company. A medical debt from a family situation that had ballooned while he was between jobs. Credit card debt from a period of unemployment the year before he joined you. He was, by the time he started the ghost vendor scheme, about $70,000 in personal debt. And he'd done the math, consciously or not, on how long it would take him to get out of that hole in his salary. The math didn't work. And he happened to be the one person in your company with the access to make it work differently. Doesn't excuse it. You need to be clear about that, both in your own head and in this story. The man stole $190,000 from a business you spent 9 years building. He did it carefully, systematically, over 3 years, while looking you in the eye every single day. The debt context is an explanation, not a defense. But you think about it. What? More than you want to. The picture of a man who was drowning quietly and found a valve he could open without anyone seeing it. The picture of him showing up every day and doing genuinely good work and also doing this. Both of those things happened. Both of those things were real. The same person. You think about it at 2 a.m. sometimes. Not obsessively. Just in that way where something lodges in you and you find it when you're quiet. The meeting is on a Tuesday. You spent 6 weeks not tipping him off. You've sat in the same office with him, eaten lunch with him twice, replied to his Slack messages with the same cadence as always. 6 weeks of completely normal. That's a specific kind of hard. The operator in you managed it. The part of you that trusted this guy for 4 years was also dealing with it. You've got your attorney in the room. Name, Daniel Forsyth, business litigation, referred by a client of yours who'd been through a similar situation. Daniel is the kind of lawyer who doesn't over-explain. He's there to make clear that this is not a conversation, it's a presentation. You're not asking Ryan what happened. You're telling him what you know. Ryan walks in at 9 a.m. He's carrying his usual coffee. He sees Daniel. He slows down. He's slightly. But you see it. That's the tell. The microsecond where the face tries to reassemble itself. He does it well. He sits down. He says, "Who's this?" You say, "This is my attorney. We're going to talk about Pacific Coast Equipment Solutions." And there it is. You've said the name you've been holding for 6 weeks and you watch it land on him and his face doesn't move, but something behind it does. The way a wall moves when there's pressure behind it that you can't quite see yet. Here's how the next hour goes. Phase 1, denial. PCS is a legitimate vendor. They supply filter assemblies for, you cut him off. You put Malcolm's executive summary on the table. 1 page. The last line. Intentional, systematic employee fraud via ghost vendor scheme. You say, "We have 42 pages. You can read all of it or you can stop." He stops, lays quiet for probably 20 seconds. Then, "I can explain this." Phase 2, the explanation. And honestly, it's not what you expected. He doesn't try to minimize the number. He doesn't try to claim partial innocence. He sits there and he explains, methodically, the way he's always been methodical, what he did and why. The debt. The original plan to only do it until he was clear. The point where he was clear of the initial debt but had started rationalizing an ongoing income stream. The number. He says the number out loud, $190,000, without flinching. He says, I know what I did. You sit with that for a moment. I know what I did. Delivered with the same directness he's used on you for 4 years for everything else. Even now, in the worst professional moment of your relationship, he's still the reliable, no-nonsense guy you hired. Except now you're understanding what reliable had been built on. Daniel takes over for Phase 3, the terms. You're not going criminal if Ryan agrees to the following. Full and documented accounting of all PCES transactions, signed acknowledgement of the full $90,000 figure, a structured repayment agreement, immediate resignation, full cooperation if any bank or legal proceeding requires his testimony, and a non-disclosure on both sides. If he refuses any element, if he lawyers up and contests the forensic accounting, you file criminal charges and hand everything to the DA. Planted detail returns, but Ryan had always told you the key to good vendor management was documentation. He said it in his interview. He rebuilt your vendor tracking spreadsheet in year 2. The same spreadsheet that caught the $7. The same documentation system he built because he was genuinely good at his job became the evidence that dismantled his scheme. You don't say that to him. You don't need to. Ryan takes the deal. He asks for 30 minutes to call someone, presumably family. Daniel steps out. You're alone with Ryan for 5 minutes before his call. He looks at you. He says, I'm sorry, I know that doesn't cover it, but I'm saying it. You say, I know you are. And you mean it. Which is the weirdest, most disorienting part of all of this. He's gone from the office by noon. The repayment agreement is signed by end of week. The structured payments begin on the 1st of the following month. The non-criminal resolution gets Ryan out of jail and gets you a repayment structure. What it doesn't get you is fast money. The repayment is structured over 5 years because that's what Ryan can actually pay. $367 a month. Or 60 months. Assuming he makes every payment. Which for the first 18 months, and you're tracking this, he does. Consistently on the 1st of the month, automated transfer, no drama. Your attorney also sends a formal complaint to the Nevada Secretary of State regarding PCES and files the appropriate reports with your bank's fraud division. The account Ryan used to receive payments is flagged. The virtual address services provider is notified. None of this materially affects the civil resolution, but it closes the operational loop. No loose ends. See, that's important to you. Karma calmly. Ryan Ortega lost a job he was genuinely good at. He lost a professional reference he'd earned honestly. He took on a 5-year repayment obligation. And he has to live with the knowledge of what he did and who he did it to. That last part isn't yours to weigh. That's his to carry. You put down the part that was yours. You kept the business. Stated plainly. Ryan Ortega created a fake company. He submitted $190,000 in fraudulent invoices over 3 years. He did this while you paid his salary, trusted his judgment, gave him keys to your office, and told people you had a great ops guy. He had a $7 and a spreadsheet template. That's the only reason you found out. Your company is fine. Better than fine, actually a little uncomfortable to say but true. The audit that exposed the fraud also revealed 3 or 4 other smaller inefficiencies in your accounts payable process that you'd never looked at closely. Malcolm's recommendations led to a vendor verification protocol that you've now built into onboarding. Every new vendor goes through a 3-step check before they're in the system. It takes maybe 40 minutes per vendor. It's the 40 minutes you wish you'd been doing for 9 years. You hired a new office manager. Different profile, not a systems builder, more of a process follower, which is honestly what you need when you've already built the system and you just need someone to follow it correctly. She's been with you for 14 months. She's good. You like her. You also verify her vendor management work quarterly. Not because you suspect her, because you won't not do that again. The repayments are still coming in, $367 on the first of every month. You've recovered about $57,000 of the $190 so far. There's a long way to go. The math on full recovery is theoretical. If every payment comes in, you're whole in year 5. You're not betting on year 5. You're watching month by month, and you'll deal with whatever the actual outcome is when you get there. The thing you think about most now isn't the money. It's the Thursday afternoon. The ordinary, quarterly, slightly boring Thursday afternoon when you almost scrolled past $7. You wonder about the version of you that did scroll past it. The version of you who closed the spreadsheet and moved on. What year 4 of the scheme would have looked like. What year 5 would have looked like. How long the thing runs before it collapses on its own. You don't do anything differently on Thursday afternoons now. You still go through the books the same way. Same format, same routine. You just don't scroll past anything anymore. Nothing. Ever. Okay. Here's what I want to leave you with. Moral. Not a lesson. Just a question I keep coming back to when I think about this story. Ryan was good at his job. That's the genuine, honest truth. The systems he built, the spreadsheets, the vendor management, the administrative infrastructure, most of it was genuinely well done. Except for one thing. Except for the part where he was using the access those systems gave him to run a parallel theft operation. Both things were true. Simultaneously. And I think about how many people are in a business relationship right now, as an owner, as an employee, as a partner, where there's that exact kind of split. Where the work is genuinely good and something else is also happening underneath it. Not always fraud. Sometimes just misalignment. Sometimes just someone who's doing the job and also quietly building something on the side that you haven't seen yet. The gap between what someone shows you and what they're actually doing. Here's what I want to know from you. Have you ever had that moment where something small, a $7 discrepancy, a weird phrasing in an email, a timing thing that didn't add up made you pull a thread you wish you'd pulled earlier? Or a thread you wish you'd left alone? Either one. Drop it below. I'm in those comments for the first 2 hours every time. And if you own a business, any size, any type, go look at your vendor list this week. Just look at it. Pick 2 vendors you haven't personally verified and verify them. Takes 15 minutes. It could save you $190,000. At minimum, it's 15 minutes of knowing your own house is clean. That's worth 15 minutes. Subscribe if this one stayed with you. New story every Thursday. Second person. You're always the man it happened to. Next week, a man discovers his roommate of 18 months has been documenting a plan to systematically destroy his life on Reddit since week 1. He finds the account because his roommate logged in on their shared laptop and didn't log out. He sees the username. He recognizes it. That one drops Thursday. These are the stories nobody planned to tell. That's why they feel the way they do.